Good morning, gentlemen. How are we doing today?
Hello. Happy
Awesome.
Monday.
Good morning.
Welcome back, Jamie, our second favorite co-host.
Jamie's all buttoned up, ready for some big calls today. So he's not getting dressed up just for our show, Will.
I was gonna say he makes us hoodie wearers look a little lazy, you know. No big deal. Just tuck this thing back here.
Hey,
but Jamie's
it's not every day that I leave my house, so
yeah.
Fair enough.
That's a good point.
Yeah.
Very fair. Jamie, how the heck have you been, my friend? It's been what, 3 weeks since we last saw you? 4 weeks?
Yeah.
Give or take? Yeah.
And once a month, it's the highlight of my month, getting to sit and talk with you guys.
Well, I'm excited. We got a good outline for this week, but yeah, go ahead.
Yeah, I don't know about you guys, but the World Cup match was just unbelievable yesterday. So exciting.
Everything a sports fan would want, even an American sports fan, when watching soccer. Goals were scored, drama happened, last-minute goals, goes to penalty shootouts.
Right.
And Jamie, that wasn't the only trophy that we saw that was won this weekend. Did we see something happen on your end too?
Yeah, so I've been in a dart league for 8 years, and this was the first season my team we won the championship. Wow. So it was pretty exciting.
Look at that trophy.
Not
That's
a
huge.
Small trophy. That's bigger than the Stanley Cup.
It is bigger than the Stanley Cup, yeah.
It literally takes up the perfect window of Michael Golden. So I think we're going to leave it there the whole show.
How many beers deep was this, Jamie?
We were drinking out of a pitcher, so who knows?
How many pitchers deep, I guess?
No. Yeah, it was, and it's a team thing. It was great. Beat our sort of arch rivals that we'd been losing to in the finals for the past few seasons. So fun times.
I love that. I love that you have dart rivals. So that's great. Well, awesome. Well, we're glad to have you back. This is a good week to jump in because you guys just released your AirDNA 2023 outlook report, outlook report for short-term rentals. So there's a lot to cover. We kind of set up I wouldn't call it a debate, more of a difference of opinions or maybe ideas and thoughts around what the future holds, and not to share it too early with all of our listeners and live viewers. But HFM, we're putting on our first, influencer roundtable, and we're going to cover actually predictions of 2023. So I'll put a link to that in the show notes and the chat. But I'm
excited about that. We've got, 8 folks who are in various segments of hospitality, various segments even within subcategories of hospitality within short-term rentals. So everyone's going to have their prediction. They'll get a chance to chat about it for 3 or 4 minutes and kind of support their arguments. And within an hour, we'll have bold yet realistic predictions from some of the louder and bigger voices of the space.
But none of them are going to be backed by AirDNA numbers. So we need to keep that in mind.
Slide them under the table to us, Jamie.
Yeah, seriously. I'm going to send you my predictions like 30 minutes before. But there was some industry news. And so before we get into the report, just 2 things. We saw Muse raise $185 million. So congrats
equity.
To Richard.
It was north of 200 if you add in debt. So
yeah, that's wild.
That's a lot of money.
So congrats to Richard and Matt. You guys are killing it. And then Inspirato announces something, and I'll let Michael take it away because I guess you're more familiar with it.
I think the cool thing with Muse is they're going after independent hoteliers and kind of more hotel-like short-term rental operators. They also have a venture arm, and we covered this maybe 6 months ago, but Muse being able to invest in some of their best integration partners is a big win for up-and-coming hotel tech. they get to align with one of the bigger platforms, and they can get some funding. And if they get funded, then Muse is going to push them to the top of the line and sell them during their sales pitches. So I really like that strategy. It flips on the head what we see a lot of times in short-term rentals, which is vendors getting squeezed by PMSs, having to give up rev share to have an integration. This seems like a win-win for both sides versus, a win for one side. Moving into Inspirato, they launched Jaunt Living. Love the concept, hate the name. The concept basically is longer term stays. So a couple weeks to a couple months. If you live in New York and you don't want to buy a place in Fort Lauderdale, you can subscribe with Jaunt Living and grab 2 months of a place down there from their exclusive collections of properties. It could be snowbirds, it could be golf fanatics, it could be ski bums, ski fanatics, whatever, where you're picking up longer term stays, higher revenues for Inspirato. They need it right now. Stock is not treating them very well, the public markets. So hopefully this provides a bit of a lift for them. But I know the snowbird market's huge in certain areas, and I think this is an interesting play. So let's see if they can execute.
100%. Awesome. All right, Jamie, we're gonna let you take it away. It's your time to shine. Let's jump into the data. I want to get into it because one, I'm not the most data driven person, I guess. So I'd love to give us like a brief overview of the outlook that you guys published last week.
Yeah. So twice a year we put out our updated forecasts. So where do we see the current year and year ahead? So we just released that. There's a few sort of highlights that I think are interesting. And we are anticipating a slight recession in 2023. That recession, and we don't expect to turn demand negative. So this year, as an industry in the U.S., we saw demand growth at about 20%. Next year, we're expecting about 6%. So that's and you can do the math. That's a pretty significant drop off in the growth rate. Supply, we're going from growing supply at 25% this year to about 9% next year. So the math there, 9% supply growth, only 6% demand growth. That means occupancies are falling again in 2023. And we already saw some pretty steep declines in occupancies in 2022. And then the lowering of occupancy sort of erodes some of the pricing power of operators, and we only see ADR growth of about 1.7% next year. Occupancy falling more than rate growth, that means average operator has a RevPAR decline of 1.6%. So that's sort of money to the bank. Everyone is sort of on average earning a little bit less next year than they earn this year. And earning less revenue is never good. A decline of only 1.6% in the face of recession, where recessions typically cause pretty deep declines in revenue being earned, pretty steep declines in demand. We're sort of coined this recession a goods recession as opposed to services travel. We expect overall travel demand to still actually be positive next year, which is much different than any other past recessions we've been in. So definitely some not so great news, but I think overall it's a pretty upbeat outlook considering what may be ahead in the overall economy.
So many questions coming off of this. I guess first and foremost for our hotel viewers, how does this track against some of the numbers you're seeing on the hotel side?
Yeah, so I think STR's forecast for demand next year is up 3%. So we're up 6%. So that's still going to mean that short-term rental industry is taking share back from hotels. We've been growing overall share of accommodated demand. So, and you take people staying in hotels, people staying in short-term rentals, and look at short-term rental share of that overall demand. Past year and a half, we've been growing about 1% a year. And we expect that to roughly continue next year. So we're getting about 14% of total demand, and it's going to be about 15% next year. So, but I think importantly, even with the recession and STR, CBRE, the other sort of main hotel forecasters also use Oxford, also incorporating that same recession into their baseline outlook, and they don't have the hotel industry going negative either. So,
wow,
yeah.
The eating up of market share of short-term rentals to hotels. What in 10 years, what does that look like? Where does this kind of stabilize?
Yeah, and I've done some research on that. I think stabilization ends up around 20%. So we've got some ways to go. The pushback on getting higher is in certain markets, and we already see this. Like, you can only grow a short-term rental supply in a city to a certain point where you just start to see local pushback. People don't want, cities don't want, and too much of their supply, too much of their housing supply going towards cities. And we found that in urban areas, once you get over about 19-20%, you start to see significant pushback, new regulation, and it's really hard for an overall city to get above that amount.
Is this where Apartments by Marriott fills a gap? Is that a hotel? Is it an apartment? Is it do those numbers roll into short-term rental, or do they roll into like AirDNA or STR?
Yeah, and it's a good question, but I think it points out to where the industry evolves to, and it's purpose-built product. So it's not homes, not apartments that were originally in the short-term rental industry or traditional long-term rental industry being shifted towards short-term. It's purpose-built. It's mixed use. And when you start having that, it looks like a more typical hotel development cycle, and it becomes one that, and growth rates just can't grow. You can't grow supply by 25% in doing purpose-built construction. So the growth rates just slowed, more in line with what we see in traditional hotels.
So are we still in a supply crunch? I know during or coming out of the pandemic, Vrbo, Airbnb, it's all about supply for them.
Yep.
Has that tamed down a good bit? Is it fairly balanced? Where are we?
Yeah, it's fairly balanced. And we saw declines in 2020 and 2021 of supply, and there was no getting around it. People pulled their homes out of the short-term rental inventory during the pandemic. We've seen significant supply growth this past year across the world. That's been great for Airbnb, been great for Vrbo, and helped them sort of growing their earnings by adding additional supply and be able to accommodate more people in those listings. That additional supply, though, has definitely pushed the occupancy and amount of revenue that each operator can earn down. And there's just more supply. Guest and demand isn't growing as fast as supply. So average revenue per listing is going down throughout, and a lot of the U.S., mostly in destination areas where supply growth has been greatest. And next year, the sort of economics of investing in short-term rentals just doesn't look as great. And interest rates are 6-7%. Home values are still elevated. We're not seeing significant declines yet in home values, though we do expect about a 10% decline peak to trough. And that's just going to make it where a new investment isn't as high as it's been. There's still going to be, this is where I'm interested in you guys' thoughts, like there's still going to be people and existing second homeowners sort of bringing their homes into the inventory. There's people that, and maybe you're losing their jobs and want to earn revenues off of either their primary residence or a second home. So we do expect some growth, and it's yet to be seen where all that growth is going to come from.
Yeah, it's like when you're talking about supply, it is definitely constrained in urban markets. We're already seeing that. We're even seeing it start to constrain in vacation rental markets. I think Breckenridge has a cap on how many short-term rentals, Palm Springs, something similar. If we're going to grow supply essentially by, or demand by another 5%, which grows the total market share by 33%. Is that good math? Where's that coming from? Where's everyone going? Is it the urban stuff that is more apartment style? Is it what Airbnb is doing on their multifamily team?
Yeah, and the supply growth is still, or demand growth is still pretty widespread. And one thing we're seeing, and we expect to see more in 2023 is international travel back to the US. That is still down 33%. And that's especially impactful for urban areas where that demand from overseas travelers coming to the US is still off more than 50%. A big piece of that was just how long the US was locked down and restricting really anyone that wanted to come to the US. So people just made plans elsewhere. And then also the strength of the dollar. And it just made and continues to make traveling to the US so much more expensive than staying domestically throughout parts of Europe or APAC or Latin America. But we already are seeing the dollar start to weaken a bit, and that could be really beneficial for urban travel next year.
Will?
Okay. I just didn't know if you're going to say anything else. Well, so would you say like I don't know, from a overall like management perspective, would you say the inventory that is larger, bigger type home style would be harder to add into the inventory growth or easier compared to like condos and kind of more of the shared living space? For me personally, I'm not dogging on the shared living space or the smaller part, because that's how a lot of people got into this whole industry. Mm-hmm. But I also feel like with the, I guess, tightening of spending in general, the bigger homes will do better in not only revenue for the management, but they'll do better because they're targeting a different type of traveler that probably isn't super worried or concerned about spending more on a luxury or higher end property rather than more budget accommodation.
Yeah, I mean, typically at the higher end, we see their earning power not as impacted as much. So if we do go into recession and the upper end of the income spectrum is still going to continue to travel, they're still going to continue to take their vacations. Interesting enough, this so far, and job losses have been seen in the tech sector though, and some of the highest earning and sectors of the economy are the ones that have seen sort of the weakness showing up first. And that's very, very atypical. But overall, we expect higher end travelers to keep traveling, and demand in those larger units, luxury units, to stay robust. And what we see Airbnb already sort of shifting their marketing to is around, and that short-term rentals are a great value play. So if we do go into a recession and you are looking to save money, that you're coming to Airbnb to find cheaper accommodation. And then sort of the push into having more private rooms, sort of shared space. And you saw Brian's now renting out his spare bedroom.
Is he?
Yeah.
Is he?
I wasn't able to book all the way up until 2025. So
okay.
Did he ever have any calendar availability, Jamie?
I don't think so.
I'll go back through the scrapes and see if there was any calendar availability.
Let us know.
I'll let you know. But that's something, and broadly consumers have moved away from, and especially during the pandemic, of you just don't want to stay in a shared accommodation. it was a pretty big piece of and what their demand was back in 2017, 2018. Like, and in New York, I think it was almost 50% of demand was staying in private rooms. And if you wanted to go to the city, like, and you wanted to save money, and Airbnb was a really great option for that. And pushing back, and I've stayed in a lot of sort of private rooms when traveling in Europe, traveling in the States, like, and it's different, but in your 20s, in your 30s, like, it's a great way to continue to be able to travel and not spend $200, $300 a night on a hotel room. So,
yeah, it's a good point.
So
go ahead.
We've seen a number of companies raise propco funds to go deploy. AvantStay, being one of the biggest, but there's 3 or 4 that have raised at least 25, 50, $100 million. And they're buying at the peak time. Do you see this blowing up and unraveling? Like, I've long loved the owner operator model.
Mm-hmm.
I do think it's a challenge, especially the latter half of this year, to deploy that capital responsibly.
Yeah, and broadly, I see them sort of buying into the long-term growth of the industry. So if institutional capital is getting in, if big pension funds, big sort of private equity groups are going to want to be buying into the short-term rental industry, they're not going to want to do it at $1 or $2 million investments at a time. They're want to be able to come in and invest 100, 200, 300, $500,000 or $500 million at a time. And I think that's a lot of what these funds are sort of gearing up for, is how do we buy the homes, build the operations, generate the cash flows that then real and large institutional capital groups would be willing to buy in to the short-term rental industry. And that's probably still 3, 4, 5 years away. So they've got some runway. And a drop in asset values over 1-2 years, and while not great, it's probably not going to sink them. And they're sort of looking at an exit still 5 years from now, and which gives sort of plenty of time for things to turn around. So as long as their investors are comfortable with that, and they've got that sort of longer time horizon, I think they're going to be okay. But not great for sort of a short term, like buy and sort of exit within a year. That might be a little bit tough.
Yeah, I mean they'll typically refinance in 2 years or so. Is what I've seen as most real estate models, but even then, interest rates will hopefully not be what they are now. I'm curious, do you see them deploying 100% equity purchases, or what? How much are they leveraging with financing?
Yeah, they're definitely leveraging. They're definitely using financing, and sort of pushes that and dollar further to be able to deploy more assets. And it's coming in at pretty high rates right now for those properties that maybe they bought a year ago. They're not going to want to refinance those, depending on the sort of debt that they took.
Year and a half, yeah.
Yeah, and 2 years out, I don't unless we go through a deep recession and the Fed's got to really cut rates, which I don't think is going to happen. I don't think they're going to do, and we're probably at higher rates for at least the next 2 years, and don't start seeing declines for maybe 3 or 4. So it may not be the best environment to be refinancing in 2 years.
And then last question on this. You mentioned the dollar is starting to show cracks and weaken. Do we get back to where it was 2 years ago, or is the dollar still going to remain stronger in a better position than most other global currencies?
Yeah. And it really depends on what happens with the recession next year. And if U.S. stays out of one and the rest of the world goes into one, that probably means the dollar staying strong. If we sort of see a broad-based recession around the world, and we maybe keep declining a little bit in terms of the strength of the dollar, but it really depends on sort of what happens next year. Europe is much more at risk for recession than the U.S. right now, given the war in Ukraine, high energy prices, consumers starting to pull back. But nothing's sort of written in stone yet.
So would it be a good time to invest in assets internationally, or?
Yeah, absolutely. And I've seen a bunch of funds sort of go out and trying to buy in Europe right now, given and their investors are coming from the U.S. They're sort of being able to buy in euros, essentially puts a 25% discount on all the properties. And
the 25% discount is an assumption that it gets back to where it was, right?
No, you're sort of converting your USDs to euros, and the sort of currency just conversion right now is, and look at a year ago to today, and you're getting 20% more euros for your dollar. So that makes it just easier to extend and what you can pay today if your money's in USDs.
I love it.
Yeah. But
let's see.
Yeah, so the big risk next year though is, and we haven't yet seen supply growth slow. So our expectation is that it slows, but it's still growing at 24% right now, year over year. We haven't seen that sort of turnover. And we're definitely seeing demand growth slow. So if demand growth continues to slow and supply doesn't, and the big risk right now is just much further decline in occupancies next year, which I'm sort of playing into sort of that Airbnb bust hashtag. It could be, and there's a risk that things could be much worse for the industry.
Short term,
yeah.
Let's see, like top couple things, 2 to 3 property managers listening now live or on the replay could do in order to kind of prepare for this. Do you think, obviously there's different business models, arbitrage versus co-host / management, ownership, all that good stuff.
Yeah. And the number one thing is going to be sort of active revenue management. So if you're not paying attention to, and your weekly numbers, like how much bookings you're getting, how does that compare to your competitors? How does your forward bookings look? And if you're not getting the bookings you need, like you got to adjust price. And if you're, and right now we're sort of in that lull, and it's really slow booking times, sort of November, December, heading into January. But come the third week of January, that's when everyone starts booking spring, summer travel. And we see, and you've got to be ready of monitoring that and adjusting prices accordingly. Because if you're just going to say, hey, we're going to stay at what we were last year and hope for the best, and you may get to a point where it's too late to get the bookings you need to sort of make the numbers work. So
we've seen a lot of stuff change since COVID. Do you think that it's safe to assume that they can kind of predict for, okay, like not doing the same as last year, even though we see the trends of like, the slow time, November, December, January, is that still going to be true, even though it's like a completely different life cycle with the industry? Obviously we saw a big boom through COVID and all sorts of stuff. So is it safe to say that, or?
Yeah, and that's where it's as much tracking pacing versus prior years as it is pacing just versus, and what are all the other units in your market doing? If everyone else is getting bookings and you're not, like something's wrong there. And you either got to take a look at your listings, take a look at your reviews, take a look at what's causing people to book other properties, and would say 8 times out of 10, it's probably price. And you gotta figure out what the price is. People are gonna choose your property over others.
Last question. We're running up on time, but how do you balance that forward-looking pricing with semi-unpredictable inflation? Like we're still seeing an ADR crunch or RevPAR crunch, despite a 8 5% inflation in Europe more so, right? So is it smart to even take bookings 9-12 months out, or should you close down the calendar during those timeframes?
Yeah, and ADRs are still growing over 5% now in the US. So we're not at inflation, but we're close. So operators still have pricing power today. If you're accepting bookings that far out, I would definitely try to be pushing price and try to get that and at least covering inflation. But then, and overall next year, we are expecting inflation to come down. So I think current expectations are we go from 7% now down to 3.5-4 by the end of next year. So that does pull it down and pretty significantly. We're not at 2.5 on where the Fed wants, but we're close to there. Yep. And if there is a recession, that does put sort of less pressure on wages, and people aren't sort of asking for 5-10% raises if unemployment's going up and you're worried about your job and you're sort of happy to have what you have. But and the hospitality industry is still in labor crunch. There's still labor crunch, and you're more than likely going to have to continue to pay more to attract workers, and especially if demand's still growing. So I would assume and expenses are going to probably be 5% higher next year. You're going to at least try to cover that with rate. And if you can't, you can't, and profits are going down.
Yeah. That's good. Yeah, seriously. Well, snap. Like Michael said, we were running out of time, but there's a lot to go into. It's a good and it's not a bad note. It's not a high note to leave, Good Morning Hospitality on the end of the year for our last show until January. So I guess there's a lot, and I think you're right on the revenue management side. So I'm glad that you brought that up. I think it's going to be the more important part of people's tech stacks as they're getting geared up for what's to come ahead. So Jamie, we're going to make sure we link this report in the show notes and make sure that everything's covered for all of our listeners that like to get some of this action live. And we got a couple of live viewers tuning in saying thank you. Good stuff. So we appreciate you joining us again, and we'll see everybody again January 2023. We'll see you guys next year. We won't see you next week. We'll see you next year.